No, she's not sick.
Yeah, that's good.
Which is good.
Technology challenge.
All right, so, ladies, we will go ahead and get started. I'm told Mr. Badalenti is not joining us, so at 2:07, we'll call the Portage County Investment Advisory Committee to order. As I mentioned, Tony is excused, and present are Sabrina Christian Bennett, County Commissioner, Brad Cromas, County Treasurer, and Eileen Stanek from Meter Investment Management. So, first order of business is approval of the minutes from June 22nd.
I have this. I will make a motion to approve the meeting minutes from June 22nd, 2023.
All right,
as presented.
And I will second. All in favor, please signify by saying aye.
Aye.
Aye. All opposed, same sign. That motion carries. All right. Eileen, the floor is yours for presenting the investment portfolio. And just as, again, a note for the live stream, while in the past we've done this on the screen, I'm not doing that here because that's too much for me to steer. This will be posted to our website shortly after the meeting. So, perfect. There you go.
Well, thank you. Thank you, Brad. Always a pleasure to provide an update, quarterly update on what's happening in the economy, the path of interest rates, and of course how this all impacts the county's investment portfolio. So moving into the presentation on page 3, we did have the Federal Reserve meet earlier this month. And as part of that meeting, they then issued an update to their forecasts, which included the infamous dot plot. The dot plot, of course, is a representation of each member of the committee's forecast of where they believe will be the appropriate level of interest rates, short-term interest rates, at the end of each year. And so we are comparing here their forecasts from June to their forecasts here in September. And as we look at the 2023 column, we can see there's really not too much change other than there is a continued consolidation around a slightly higher level than where we are today. Today, the overnight rate is at 5.25% to 5.5%, and the forecast of the Fed members, for the most part, is that we would have one more rate hike in 2023. Now, as we look out into the 2024, 25, and 26 dots, we can see that there's a fair amount of dispersion among the dots, indicative of a lack of consensus insofar as where this economy is heading, and therefore what will be the appropriate level of rates. But the overall trend of the dots is lower rates in 2024, 25, and 26. With the Fed ultimately looking to get that overnight rate back down to around 2.5%, which would be in line with the level they feel is appropriate if the economy is in a position of full employment and stable prices, which are the Fed's mandates. Now we know the Fed has their forecast, but the market has their opinion as well as professional economists. So on our next page here, and this page had not yet been updated for the most recent dot plot, but the conditions hold the same. So visually, it's still appropriate. We have the Federal Reserve, which is the turquoise line. We're reflecting a little higher rates by the end of this year, and then rate cuts starting in 2024, ending 2024 below 5%. And then the dark blue line, that is the professional economists. This would include folks from the academia world as well as the large financial institutions. And very similar trend on their forecasts. And then the green line is the Fed funds future, which is indicative of the market, and same trend. So while the magnitude of any change in interest rates is not the same, the trend is still the same, which is lower rates in 2024. And when we look particularly at the Fed funds futures markets today, and we look at the next upcoming Fed meeting, which is November 1st, expectations are no change in rates on November 1st. But then on the subsequent meeting, which is December 13th, at this stage it's about a 60% probability still that the Fed actually may not even do anything. So the market is saying very possible that the Fed will not move rates even in 2023.
That's high.
Yeah, it is rather high, 60%.
Yeah.
One would expect it to be kind of flipped the other way.
Because what's inflation today?
Inflation's 3-ish.
Yeah.
Yeah.
I remember it was like 11.
Yes.
I mean,
And 2 is the target, so we're
Yes.
approaching target.
Approaching, yes, absolutely.
yeah.
Yeah, and it's interesting with inflation, we always want to keep in mind, inflation is a measure generally of a year-over-year change. So the rapid increase in prices that we had in latter part of 2022, 21 and into 22, before the Fed started to finally raise rates, and then of course the increase in prices that we had throughout 2022. Much of that is kind of history. So when we're looking at the inflation numbers now, it's really comparing where was the level of prices a year ago to where they are today. So if prices are still rising, but rising at a slower pace, then that translates into lower inflation.
Yeah.
Yeah.
Mhm.
So very unlikely many times that prices actually fall, except for large items like used cars and homes. That's more so where we see, those really major
Impacting.
up and down variations in prices. But, things like food, clothing, services, those tend to, if they increase, they stay, become very sticky. So right now, the Fed Funds Futures Market is anticipating that by the end of 2024, that the overnight rate will be down in that 4.5 to 4 3/4 range. So that's almost a full percentage point lower than where we are today on the overnight rates. And this is a story that we have, it's continued throughout 2023 so far. So the market and the Fed really have not changed their long-term view as far as what the path of rates will be. It's just a matter of the timing. The consumer remains resilient, the economy has remained relatively stable, and so consequently, this just keeps getting pushed out, but it is inevitable.
Mhm. Is the discrepancy here between the dot plots and the economists and the futures rates normal? That's a pretty big gap.
It is a big gap. Normally, in the short end, it's normally pretty much aligned, and in the longer end, you're right, it's generally not that broad. What we believe, of course, is going on now is that the Federal Reserve is messaging higher rates for longer to try to really slow the economy. The markets and economists are saying, well, the higher rates we have today are taking their time to trickle into the economy, and so they believe that the Fed will be pivoting sooner than what the Fed is saying. So we have this, what we call moral suasion going on, coming out of the Fed.
Sure. And these are all else being equal projections too, is the other thing, not taking
Yes.
into account government shutdowns or recessionary
Right.
things or any of that stuff, so, okay.
Yeah, exactly.
Which I'm sure we'll get to, but
Well, we'll see on the government shutdown. We'll know
Yeah.
more. We'll know more for sure
By
next
the end of-
week.
yeah, by the end of the week.
Right. But any event, one of the areas that, of course, has been kind of a strong suit in the economy of late has been the services industry. And so this is a graphical representation of the ISM Services Index. This is a diffusion index, so they survey their members. If the members say that their business activity is expanding, it registers over 50. If their business activity is slowing, it registers under 50. So it's looking at, the number over 50 versus under 50. And so we can see the dark blue line is actually the index number. It's been hovering around 50. It's a little, there's variation month to month. It doesn't necessarily always follow a steady path in one direction. But that being said, the fact that it is down from the highs that we experienced coming out of the COVID lockdowns in 2021 is definitely a sign that the consumer and businesses' use of services is down from that initial, shock effect that we did have. And things are starting to perhaps return to a more normal, if not a slower version. Of course, the dotted line is the prices paid, and that represents, gives us an idea, reflective of the inflation that has occurred as well in the services industry. It's interesting when we look at the economy as a whole. One of the other indicators we look at is the leading economic indicator, which is, the objective is to give us a forward view of where the economy is headed, and when it turns down and is sustainably turning down, that's generally a sign that economic activity will slow considerably. And during this time period, that index has been down for 17 months. So it's been a little slow in its predictability, but it's inevitable because it is very reliable over time. Now, the next page, we know the labor market is another component that certainly bears watching. In this consumer-driven world, as long as everyone has a job, then they have the means to continue to spend. And so two measures that kind of are subsets of the overall labor indicators that are followed. One is the average weekly hours. This is on the left-hand side. That's a measure of the number of hours that workers work. And so, of course, if companies, sales are going strong, then they need workers to work longer hours. If things are starting to trail off, then of course they reduce them. And so we can see here, graphically, that the number of hours worked has been dropping, and we're back to levels, pre-pandemic. And even today, the most recent read was still at that 34.4 level. So staying rather sticky with being at pre-pandemic levels. The other factor too is, when folks do get laid off and they have to file initial claims for unemployment, that also shows up, and on the right-hand side, we're tracking that number, and that's a very volatile indicator. And of late, it certainly has dropped this is a weekly measure, so this is just new people who are filing their claims. So this past week, it was down to 201,000 workers filing initial claims. Last week, I think it was 204,000. But we can see that sometimes it peaks up, well above that level. And one of the warning signs is generally if it's above 250,000 claims. But one of the things that we are seeing is, and there's been a lot of talk about, is this concept of worker hoarding. Because it's been so difficult to find workers, that even if companies don't necessarily need all the workers they have today, they're not laying them off. Because mindset is, when business activity returns, that would put them in a difficult spot of now trying to find new workers. So interesting dynamics at play here. But this kind of goes hand in hand too with when we look at the number of jobs that are open in the U.S. economy. Go back during the summer, there was upwards of 11 million jobs, available jobs. Now we're down below 9 million jobs available. So clearly, companies have determined that, oh geez, maybe I don't really need to fill all those open positions I had, so I will no longer post them. Don't need those positions. And when I drive around the state, the number, we don't see all those billboards of offering bonuses. We don't see all the, pay you weekly, please come to work here. Type signs. So clearly the labor market is, I would say, returning to a more normal state. Now, at this point in the economy and this point of the interest rate cycle, we felt it was helpful to take a look back at prior interest rate cycles. So what we are demonstrating here on page 7 is looking back at interest rate cycles since 1993. So this is a 30-year look back. And we're comparing the turquoise line, which is the Fed funds target, to the yield on the 2-year Treasury, which is the green line, and the yield on the 5-year Treasury. And as we could see, as we dissected this data, is that, as we know, when the Fed raises rates to, slow the economy, whether because it's overheating, activity is too strong, or to combat inflation, like recent and like in the 1980s, that they reach a point when then they pause. And then generally, then the next move is a rate cut. And so the rate cuts when they become really necessary, tend to be rather swift. So as we can see in the the dot-com era or boom back in 2000, when the Fed cut rates from almost 7% all the way down to, by 2002 we were down to 1%. That rate cut cycle occurred very quickly, and then of course the housing crisis, and then COVID as well, when the Fed returned rates back to that zero level. But from our standpoint, it's recognizing, okay, the overnight rate can move very quickly, but what happens with those longer term rates, those 2-year rates, those 5-year rates? Are they giving us signals in advance? And the answer is yes, because the 2 and the 5-year rates reflect the market's expectations for economic activity and inflation. And so when those longer term rates start to drop, they do so in advance of the Fed moving. And that signaling can occur, as we've seen in these past 5 interest rate cycles, can occur anywhere from 5 months to 11 months prior to the Fed making their first cut in rates. And then the magnitude of the cuts range, magnitude of the drop in those longer term rates, can move from 50 basis points to 2%. So clearly, those are pretty sizable downward movements in longer term rates. But overall, we know, as we can see, the longer term rates are more often than not higher than the overnight rates. And so we generally are not in an environment like we are today, where we have a yield curve inversion, which has been in place now for some time, although today it's been starting to flatten a bit. So again, market's very volatile, to say the least. But we think, as we look at this and we look at where the Fed is on the interest rate cycle, where we look at where the economy is headed, it continues to support our strategy of locking in those longer term rates, getting ahead of those rates starting to drop, signaling that the Fed's next move will be lower short term rates. All right, any questions or comments?
No.
Okay, perfect. So looking at how this has impacted the county's investment portfolio, at the end of August, it had $55 million in cash. Most of that, of course, is invested in either Star Ohio or overnight bank accounts that are paying comparable rates, and then $67 million in the securities portion. So at this stage, the weighted average maturity is kind of right in the middle there at 2.46 years. We will look to continue to push that just a little bit north of 2.5 years, again, as we look to continue to lock in those longer term rates. The portfolio is yielding 2.87, which is up from last quarter. We're at 2.75. So we're moving in the right direction. Of course, as we know, the portfolio is comprised of securities that were bought in different interest rate cycles, as well as this current one.
Yeah.
So it will take some time. But even at the 2.87 with the $167 million, that will generate about $4.8 million of interest income. And so our objective is, let's try to make that more sustainable, and not have 2024 and 23 be the banner years and then interest income falls off the cliff. Looking at the maturity distribution, our objective is to have a little over 40% maturing beyond 3 years. At this stage, we have 38%. So as we have maturities within the 1 year, over the next few months here, we'll be able to reinvest those longer term. It's interesting that of the 21% that we have maturing beyond in that 4 to 5 and 5+ year bucket, those securities, that 35 million, have a weighted average yield of just under 4%, 3.74. And so if we do the math, that equates to those investments will generate $1.3 million of interest income each year for 4 years. And so when we flip to the next page, we can see, when we look at historically, or not the next page, I was a little ahead of myself, 2 pages ahead. When we look to the interest income that was received, that the portfolio generated like in 2020 and 2021, you know, we're looking to try to lock in interest income above those levels for multiple years. So again, to provide that stability in interest income. And one of the ways that, of course, 2 ways we'll be able to accomplish that. Number one, by getting more, continuing to build up those longer term holdings. And then, of course, as we're reinvesting, you know, at current rates. And last quarter, the investments that we made yielded on average over 4%, which was up from the previous quarter's purchases, which were just on 4%. So things are moving in the right direction.
Absolutely.
It's a gradual process. Yeah, that's what it comes
Depending
down
on which end you're on.
Yeah, right.
Well, ideally, it's gradual in both directions, right?
Yes,
Yeah.
exactly, yes. So, any other questions, comments?
No, you're doing a good job,
Thank you.
as always.
Okay, well, if there's no questions for Eileen, thank you very much for walking us through that.
Yeah. It's always
Um,
good to have your update and perspective.
A motion to accept that portfolio as presented.
I will, second.
And so I'm gonna have you move it, cause
Okay, I'll
I'm
move it.
sharing. So yeah, I'll second it.
Okay.
All in favor, please signify by saying aye.
Aye.
Aye. No abstentions or no votes, so that passes. And then other business for this meeting is relatively minimal, just an update on GrowLink. That continues to go very well.
Yeah.
I believe and I apologize for not bringing numbers up with me today, but we're under $250,000 left available for lending in that.
Cause we had what was our tax?
2 million to
2?
begin, which, if just for frame of reference, our prior program, which was just under $1 million, never reached $1 million in lending.
Yeah.
Only got close to that number after about 6 years.
Yeah,
So it's pretty impressive that in just over a year we've used almost all of our allocation. I'm considering making a recommendation at some juncture to add a little more to it. I think we could potentially do another $1 million in the program and have that be used. So especially as the rates continue to be stable and a little higher than they have
Yeah.
historically been. So, you know, that's a thing perhaps at the next quarterly meeting to have a conversation about more fully with whoever is in my chair at that point. So, just as a point of reference, I don't think there's anything to vote
Yeah.
on there. I don't know if you have any thoughts about that, but I'm really happy with how it's gone.
no, I was just
Um,
gonna say, when you
yeah.
said we have like $250,000 or less, that's impressive to me, because we just increased the availability, of what the funds could be used, you know, and extended it to businesses and agriculture and stuff, so that's pretty impressive, and
Yeah.
it indicates that there's a need.
Yeah, I think our timing on the agricultural cycle wasn't great,
Yeah.
because we got it out in summer.
Mhm.
And so, and the word getting out hasn't been as strong
Yeah.
in that community, so that's a piece I'm still waiting our first loan on. A lot of business loans and a lot
Yeah.
of trucking business loans for some reason, and I'm
Yeah.
not sure why that sector picked up. Word of mouth probably, right, but it's just, that's been an interesting kind of thing to watch too, is where the loans are going and what sort of work is happening, but,
Cause I thought I saw Duma on there, was he agriculture or was he?
deer processing,
deer-
so we're calling
yeah.
that the business sector one.
Okay.
Yeah. So.
I was, yeah.
Yeah, well, Portage County, baby. There you go. So, all right. Well, if there's nothing else, then, and there are no objections, I'll consider us adjourned at 2:30 p.m. Our next meeting is in December, so we'll see you then.
All right,
Thank
sounds
you.
good.
Thank
Thanks,
you.
Eileen.